I'm Kara Murphy, and this is Money with Murphy. It's earnings time again. Those few weeks every quarter when the country's largest companies give us insight into how their businesses are doing. An interesting trend is afoot. While corporate earnings are improving, stocks are still getting punished. As one Wall Street Journal headline read, earnings season is shaping up nicely, investors don't seem to care. For context, as of the end of October, about half the companies in the S&P 500 have reported third quarter earnings. Of those, nearly 80% have announced earnings above analyst estimates, an impressive rate that's above longer-term averages. That said, when companies have reported those better than expected earnings, the stocks haven't enjoyed the lift that we would normally see. In fact, on average, companies that reported an earnings surprise have declined by 1%. This phenomenon comes even as we reach an important turning point in that earnings are growing again after several quarters of declines. From the recent peak to trough, S&P 500 earnings in aggregate will have dropped almost 10%, a level that's consistent with a mild recession. That suggests that the bad earnings news is now behind us. For the remainder of this year and into 2024, earnings are expected to rebound handsomely. Looking at earnings by sector reveals some varied experience. Two sectors have seen over 90% of their constituents report earnings above estimates: communication services and information technology. Not surprisingly, they are also two of the best performing sectors so far this year. Now, we've talked in earlier pieces about how concentrated the stock market has been. Just a handful of large stocks have contributed the bulk of the S&P 500's returns since January. And we see a similar pattern when it comes to earnings. For instance, earnings for communication services companies grew in the third quarter by over 40% compared to the previous year. But take out Meta, otherwise known as Facebook, and that number drops to 29%. Still impressive, but much lower. Similarly, consumer discretionary earnings fall from 33% to 15% without Amazon. Some themes were evident during company calls with the investing community. Artificial intelligence remains a focus. Now non-tech companies seem increasingly focused on using AI to help drive smarter decisions, interact with clients, and be more productive. While many managements have mentioned the impact of higher wages, U.S. consumers appear to be continuing to spend, with back-to-school sales strong and leisure travel now returned to pre-pandemic levels. So what does this all mean? Better than expected corporate earnings is consistent with the strong GDP growth released last week. With the recent weakness in stocks and favorable seasonal tailwinds expected to pick up shortly, we remain optimistic heading into the end of the year. So until next time, invest wisely and live richly.